So why have I been spending so much time talking about means and standard deviations? Because we can use the same concepts that I related to your exam scores to stock returns or bond returns, returns on any kind of investment. You might remember from uh, chapter 3, I recorded a video on and compared the returns on stocks, large caps and small caps versus um, bonds. Well, from that particular video, I am pulling the mean return on large cap stocks. It was approximately 12%. It wasn't exactly that, but I'm going to just round. And then I had also calculated the standard deviation, which I'm just going to abbreviate as SD, and that was approximately 20%. Again, this was for large cap stocks. Small cap stocks had different means and standard deviations. So, since I know the average return on a stock and um, the standard deviation of that mean, I can calculate things like what is the likelihood that I will lose money if I invest in large cap stocks. Oh, it's early in the morning and I haven't had my caffeine. Oh. So, to answer this question, I need to calculate my z-score. And the formula for z-score, again, is the desired number minus the mean, or the average. And then that answer is divided by the standard deviation. So the desired value this time is 0%. If I lose money, then I'm going to earn less than 0. And so then subtract the mean of 12% and divide that by 20%. So that's going to be minus 12 divided by 20. And I'm just going to do 12 divided by 20. Gives me 0.6. I probably should have been able to do that in my head. It's actually going to be minus 0.6. And so now I would pop over to my z table, which I have here. And again, this is a symmetrical, oh, I don't really want to use red. This is a symmetrical distribution, so whatever this black shaded area is, which is on the right side of the 0, so it's a positive number, is going to be identical to whatever this orange shaded area is, because this is a symmetrical distribution. So I'm going to look up 0.6, and it's 0.60. So I would go down to 0.6 and then across to the 0, the second decimal. And so I get 22.57%. And so now I'm going to go look up z value from table, and it is 22.57%. Now that I have that z value, I am actually interested in this number. Well, I will use my pen again. The z value that I just looked up gives me the orange shaded area, but what I really want is this blue shaded area, because this technically is where the minus 0.6 is. So I want the probability of losing money, so that would be from the minus 0.6 standard deviations away from the mean all the way to the left. So to find the blue shaded area, I would take 50% minus the value of the orange shaded area, which was 22.57. And that's going to give me what? 27.43%. I'm going to go ahead and go type that into Word though. So I take that 0.5 minus the 22.57. I'm gonna need to keep my decimals straight, and that's going to give me 27.43%. So that is the likelihood of losing money if I invest in large cap stocks. Now let's contrast this to an individual stock. Remember the returns that I had on that spreadsheet back in chapter 3 were the returns on the Standard & Poor's 500 index. So it was a group of 500 different stocks. Let's say I've got an individual stock like Amazon, and it might have an expected return of 12%. I'll go ahead and do it that way, just like large cap stocks, but individual stocks tend to be far more volatile, which means they have much higher standard deviations. So the standard deviation of Amazon might be 60%. So to calculate the likelihood that I would lose money if I invested in Amazon by itself, I would do the Z-score, and it would be 0%. Again, the likelihood that I'm going to lose money minus the mean of 12% divided by the standard deviation of 60%. That's going to give me 12 divided by 60, 0.2. Again, minus 0.2. So I would pop over to the Z table, go down to the 0.2, so there's 7.93%. And I'm going to explain this one more time using the graph, but then I'm going to stop using this graph. That's one of the uglier distributions I've ever drawn. So what I just looked up was this value in blue. It is, I forgot what it was, 7.93%. But it also equates to the value of the yellow shaded area, because this is a symmetrical distribution, and I actually had a negative 0.2 when I calculated the Z-score. And what I really want is this light blue shaded area, which I calculate by taking 50%, since I know from where my cursor is all the way to the left is half of this distribution. If I subtract the 7.93% from 50%, that will give me this lighter blue shaded area. So 50% minus 7.93% gives me 42.07%. So this is the likelihood of losing money if I invest in Amazon, an individual stock that has a much higher standard deviation. So again, I'm going to pop this over into Excel. So I looked up the Z value from the table, and it was 7.93%, and then I took 50%, subtracted 7.93% to give me 42.07%. So even though the S&P 500 and Amazon both had the same expected return, because Amazon was so much riskier, it results in a higher likelihood of losing money. So, what I'm trying to demonstrate with this is investing in a collection of securities, stocks for instance, so stocks and or bonds results in less risk, and therefore that increases your likelihood of generating a positive return. Also, it's relatively expensive to purchase stocks directly because I may have mentioned this before. We tend to purchase stocks in round lots. Again, you don't have to. Well, first, let me say a round lot is 100 shares. And so, you could buy just a single share of a stock, but you have to pay a commission when you buy stocks through your stockbroker. And that's essentially the only way to really directly purchase stocks through a broker. Like I just bought some stocks yesterday and my charge was $10. That's what I had to pay my broker just to engage in the transaction for me. And then I also had to pay the cost of the stocks themselves, which were like $30 a share. Um, so, if I wanted to buy a lot of different stocks, I would buy probably them in round lots, and that could be pretty expensive. So I'm going to pause this for a second and collect some data because I forgot to get it earlier, but I'll be back. Alright, what I have on screen now are the 30 stocks in the Dow Jones Industrial Average. Again, these are really giant companies, and you're probably familiar with all of them. And I have the price, the most recent stock price for each of them. And so what I want to do is calculate the cost of a round lot of 100 shares. So if I were to buy 100 shares in Apple at $115.45, it's got some weird things going on because I cut and pasted this from the internet. So I'm just going to scoot that over a little bit because it's got some little boxes here. I just can't see them. So to calculate the price that the amount of money I'd have to spend if I bought a round lot of Apple, I'd take 100 shares times the price per share of 115, so $11,545, and I'm just going to make that a little bit bigger so hopefully you can see it a little better. And I'm just going to format as a dollar amount. And then I can just copy this down and Excel will figure the price for 100 shares of each one. So 100 shares of American Express would be 100 times the price of $75.32. So one round lot in each of these 30 stocks. And now down here I'm going to just sum the cost of each of the round lots. So it's $245,000 to buy one round lot of each of the Dow stocks in the Dow Jones. And that's only 30 stocks. That's not an incredibly huge portfolio. Um, but even so, it's still going to cost quite a bit of money that many, if not most, individuals don't have. So it's expensive to buy a round lot of the Dow Jones. It just takes quite a bit of money. And not that the Dow Jones is the be all and end all and everybody wants to own that. I think owning the Dow Jones is not sufficient. It's only 30 stocks and they're all giant caps and they're all based out of the United States. So in my opinion, it's not nearly diversified enough. I need to satisfy my degree of diversification levels, I need quite a few stocks more than just the Dow Jones. So just only buy the Dow Jones stocks it's expensive. To buy even more, if I bought them in 100 share increments, would cost a whole lot more money. So it's expensive to buy the Dow Jones stocks in round lots. So what can we do to combat this? Is there no hope for the individual investor who doesn't have a lot of money? The answer to that is there is hope. What we can do is buy shares in a mutual fund. So what is a mutual fund? Essentially, I'm not quite sure when they started. I believe it was the early 1900s, but investment companies who realized that people like you and I wanted to perhaps have someone else manage our money, and B, to be able to put small amounts of money in, but by doing so still have access to a huge variety of different or diversified portfolios. So investment companies created mutual funds which allow investors to contribute small amounts of money. Now you can contribute large amounts too if you want to. Plenty of people do. To a collection, and that money is used to purchase a variety of different securities. And so what we do when we deposit money into a mutual fund is we actually buy shares of the mutual fund itself. And with the cash that the mutual fund gathers from all these thousands, if not millions, of different people who are putting small amounts of money in, they will use that money and buy, 500,000 shares of Apple and 100,000 shares of Microsoft or what have you. So, some examples of investment companies that perhaps you have heard of, uh, there's the Vanguard Company, Charles Schwab. Vanguard's really well known for having funds with very low fees. Charles Schwab is known for having funds that require fairly small minimum investments. I believe of about $25 a month is all you need to add each month if you want to do that. You can always add more, but I know a lot of younger people are saying, I don't really have $1,000 to put in every month. Well, Charles Schwab doesn't require that you put in a huge amount like that. They'll accept smaller increments of $25. BlackRock is another management company. John Hancock, TIAA CREF. There's really hundreds of investment companies. The main one I'm going to talk about is Vanguard. Um, the one reason that I like Vanguard, they're very well known, very well established, have a nice selection of index funds, which I'll explain in a later video, with extremely low fees. The only issue with Vanguard is you do need, I believe, $3,000 to open an account and to purchase into a fund. So this Vanguard might not be the right fund for you. Y'all might be more interested in Charles Schwab, but I personally use Vanguard for the reasons that I mentioned. So these different types of investment, or these different investment companies, offer a variety of types of mutual funds. The first type, and we can classify these into 4 different types. The first type is a money market fund. These mutual funds invest in very low risk, low return securities, such as U.S. Treasury bills, not Treasury bonds or notes. Money market mutual funds are subjected to this regulation that they cannot own a security that has more than a certain length of time until maturity, and I can't remember exactly what it is. I want to say it's 90 days, but that seems a little short to me. I should look up that rule. So, money market mutual funds cannot own long-term securities. So they can't own U.S. Treasury bonds, but U.S. Treasury bills are shorter term in nature, so they can own those. Um, Remember how I talked about my certificates of deposit that I uh, have laddered and put some of my emergency savings in? Certificates of deposit, or CDs, like my CDs, are not negotiable. If I want to, well, I need to explain what that means. If I wanted to cash in my CDs, I can't sell them to somebody else. All I can do is go to the bank where that issued them and turn them in, and I'll pay a penalty for cashing them in early. If I wait until they just mature automatically, then there's no penalty. But if I really need the money and ask to cash them in early, I just have to return them back into the bank and pay that penalty. If, though, you buy CDs with a large enough denomination, so let's say my CD is $10,000, that's not a large enough denomination. It needs to be of $100,000 or more to be subjected to what I'm going to say next. But if you buy a CD with a large enough denomination, they're negotiable, which means they can be sold to someone else before maturity. So, and you don't pay a penalty for cashing them in because you're not actually cashing them in, you're just selling them to somebody else who's willing to hold them until maturity. They also pay better rates because they have a much larger amount invested. So to be negotiable means they're sellable. I don't think I'm spelling that right. Money market mutual funds have enough money to buy CDs with a minimum denomination of $100,000. So they're able to earn much better rates than I'm able to earn on my CD because it's not $100,000. They also invest in something called commercial paper. Commercial paper is a debt instrument sort of like a bond, except that it's short term in nature. Bonds are traditionally long term in nature. By long term, I mean more than a year. Commercial paper has less than a year until maturity. They're issued that way, but they're typically only issued by the highest or strongest financially companies. So companies like Apple, which have plenty of money and are generating lots of profit and are easily able to repay a debt security, might issue commercial paper. Smaller companies that are not financially sound don't tend to issue commercial paper. So commercial paper as an investment is fairly low risk. It's also it also has a very high denomination, like $1 million. That's the least amount you can put into commercial paper. So again, you and I as individuals won't be buying commercial paper because it's got too high of a denomination. But money market mutual funds, which easily have many, many millions of dollars invested in them, can easily afford to buy commercial paper. So again, these money market mutual funds are low risk, investing in low risk securities. Low risk securities by nature just generate low returns. But it's a good place to keep money that you need in the short run, but you want to be earning a return on it. I'm going to pop over to uh, Morningstar. Morningstar is a great place to look up data on mutual funds. They have a premium service and also a free service. I actually subscribed to the premium service at one point, and I want to say it was about $200 a year. But in my view, just did not find $200 to be worth it. Because Morningstar offers so much information on their free service that I'm now back to just their free service. But I want to look up the Vanguard Prime Money Market Fund, and I'm going to do this one. You see how there are actually two of them, but one of them has INV and one of them is INSTL. INV stands for individual investor. INSTL stands for institutional investor. Institutional investors are companies are entities that have huge amounts of money to invest. Sometimes the minimum to open an institutional account is $5 million. We want the individual investor accounts where the minimum to open is for Vanguard, I believe, is 3,000. Now you can add smaller amounts to it once you have your account already open, smaller amounts of like $100. But to actually open your account needs that initial 3,000. So this particular money market fund has $136 billion invested in it. It has expenses of 0.14%. I'll explain in chapter 9 what exactly that means. And again, here's that minimum $3,000 investment. But what I really want to go look at is the portfolio and just look at some of the things they've invested their money in. So this pie chart gives a breakdown of 5 broad asset categories that a mutual fund can invest in. So they can have their money in cash, and that doesn't actually mean dollar bills lying around. What it means is short-term securities such as treasury bills, certificates of deposit, things like that. So 92% of their money is in cash. That's where I expected it to be because it's a money market mutual fund. It doesn't own any stock, and it shouldn't. It doesn't own any U.S. stock or foreign stock, but it shouldn't because um, it's not that type of mutual fund. Stocks are risky, so this fund shouldn't be investing in risky securities like that. It's got a little bit in bonds, um, and then something in other. I don't know what that would be. But if I go to holdings, I can see it doesn't list all the holdings. For the free account, you need the premium account to see all of those holdings. But I can see some of them. So you can see here's a treasury bill, um, another treasury bill. Here's a treasury note, but treasury notes, even though they were originally issued with at least 1 year until they matured, you know, let's say you issue a 2-year treasury note and a year and a half has passed. So now there's only 6 months remaining until it matures. That makes it a shorter term security, and money markets funds could then invest in it. Remember how I said certain government entities issue bonds and financial or debt instruments? Here's one of those, the Federal National Mortgage Association. And here's another. Again, these may have had longer maturities when they were initially issued, but now some time has passed and they're shorter term. And so these money market funds are buying them. Here's even some securities issued by the Royal Bank of Canada and the Bank of Montreal. So they have some outside the US securities, just not stocks. And this just tells me the proportion of the portfolio that is invested in this particular type of security. And here you can see they own a lot of them because they're so giant. They have, I've forgotten how much it was, like over $100 billion invested in them. So let's look at what kind of returns these securities generate for the money market fund. So I'm going to go to expanded view. give us a longer term time period. And this is an interesting reflection of what's happened recently. So back in 2005, this fund generated an annual return of a little over 3%. That's not bad for a low risk type of security. Certainly better than my savings account was generating in 2005. 2006 and 7 it did even better. So to earn 5% on a low risk security was superb. At least I think that now, because look at what has happened since the financial crisis. Since the financial crisis, interest rates on low risk securities has been incredibly low, the lowest that I can ever recall. And there's been some talk recently about the Federal Reserve raising interest rates. Um, and they were, I think it was just last week or perhaps the week before when they met, and it was it was anticipated that the Fed would raise rates, but the Fed didn't raise rates. So you can expect rates to be lower for some time to come. But you can see how low the return has been for the past, 6 years. So this is 0.53%, and they've been just really low for those last 6 years. Hopefully, in the near future, they will start to go up. What, I actually have some money in a money market mutual fund. It's the money that I keep in my brokerage account. So, for instance, right now, my savings account pays better than 0.01%. My savings account pays 0.5%. So it doesn't make a whole lot of sense to, at the moment, have much money in a money market mutual fund, but I do have some. Just at the moment, I think a few $100s because it's the money that I have in my brokerage account. The way that a brokerage account works is, let's say I deposit $50,000 in my brokerage account and I spend 49,000 of it buying stocks, but there's 1,000 left, and I could take that back out and pop it into my savings account, but I'm going to have to probably do a wire transfer, which might cost $20. And then when I'm ready to put it back into my brokerage account, I may have to do another wire transfer to get it back into my brokerage account, which would cost another $20. And I don't want to spend $20 wiring money back and forth from my savings account to my brokerage account. No, not small amounts like $1,000. It's just not efficient to do that. So I keep that $1,000 and in my brokerage account, and what my broker will do is automatically put money that I don't have invested in any securities into a money market mutual fund. Then when I'm ready to use that money to buy some securities, the brokerage firm will automatically take it out of that money market mutual fund and use it to buy the stocks for me. So that's why I have just a couple of $100 right now invested in a money market mutual fund, because it's money that my brokerage account has that I just don't have invested in stocks right at this moment. Okay, so right now they're generating low returns. Actually, I'll say extremely low returns. But they were around 4% prior to the financial crisis. That doesn't mean they were at 4% every year before the financial crisis. It was 3% one year, 4% another year, and about 5% the year after that. So we just realized the returns that these money market mutual funds will earn does vary. And so I looked up the Vanguard Prime Money Market for individual investors, and I think the ticker on that one was VMMXX, if you are interested in that. I'm only telling you this to give you examples. It's not that I think this is the be-all and end-all of money market mutual funds. I don't. But I also don't think there's anything wrong with it. So Another type of a mutual fund is a stock mutual fund. And sometimes you'll hear those called equity funds. It's the exact same thing. Now, an equity fund can be really focused. It can be focused on, let's say, small cap mutual or stocks. So it can be a small cap fund, a large cap fund, a mid cap fund. It could even, be a micro cap. I don't know that I've ever seen a giant cap, but a large cap fund would also have giant caps in it. Or you could have an equity fund that's diversified across all different market caps. I can't remember if I've discussed this already, but some people divide equities into value versus growth. A growth stock would be stock in a company that's in an industry that's growing really rapidly, or the company itself is growing really rapidly, and it's expected to do well for that reason. The stock is expected to do well for that reason. A value company is a company whose stock may have been beaten down by the market because one negative thing happened. Now, here's a good example, and I'm not saying I think this one is a value stock, but it's something that happened recently. Um, and I haven't really looked at uh, this company enough to research it and tell you whether I think for sure this is a value company. But Volkswagen, oh, I didn't mean to hit enter. I'm trying to get to a quote, and here this works. So I'm just going to go for the past 3 months, I think. Should be good enough. Ooh. So if y'all are watching the news, you may be aware that recently Volkswagen admitted it had been falsifying, I believe, uh, data on its emissions, and it was actually producing much higher emissions than were allowed by the United States standards. I think that's what's going on. Look at the price of Volkswagen stock. It went from a high at some point in the past. Oh, actually, here's the high. The high at some point in the past of what, 219 and dollars a share, and then after they admitted that they had falsified the data, its price has dropped drastically down to 107. So it's dropped by more than half, really just in a matter of weeks. So the market has reacted extremely negatively toward Volkswagen's issues. But does that mean that Volkswagen is going to go bankrupt and it's never going to recover from this problem? It doesn't mean that. Volkswagen could very well experience a resurgence and do fine and maybe end up at some point in the future at higher than its previous high of 200 whatever dollars. So Volkswagen might at this point be a value stock, a stock that has just been beaten down by the market but should recover. Again, I'm not saying go and buy Volkswagen. I don't know what's going to happen with Volkswagen, but it's just a potential example of a value stock. So, growth stocks are expected to earn nice returns because they're in a growing industry or they're doing things right as a company. Value stocks are expected to generate positive returns because those people who invest in them and believe they're value stocks just believe the company's stock has been unfairly uh, beaten down, and the company itself is still financially strong and a viable firm. So, at any rate, you can find mutual funds that focus only on value stocks, and you can find mutual funds that focus only on growth stocks. You can find company or funds that focus only on domestic stocks, so companies that are based only in the United States. That doesn't mean they don't do business outside of the US, but the headquarters is based in the United States. Or I could find a fund that invests only in foreign stocks. And they could be based only in foreign companies in, let's say, Australia or Thailand. So they can be very focused on which foreign country that they invest in. They could be focused on developed stock markets versus emerging markets. I mentioned those before. So a developed market is like the United States or Japan or England. We've had capitalism for many years and publicly traded companies and stock markets for many years. Emerging markets would be, for instance, Peru, which has only fairly recently, in the whole scheme of things, had publicly traded stocks. Emerging markets are typically considered to be a lot riskier than developed markets. I could have a mutual fund that focuses only or on specific sectors. So maybe it only buys stocks in the technology sector or the financial services sector. So if you think a particular sector will do better next year, maybe you want to put some money in a sector focused fund. There are even funds that focus on specific industries. Remember, the sectors represent the broad market of stocks. Industries are more focused within sectors. There are also funds that focus on income. So some stocks pay dividends whereas others do not. So maybe they only own stocks that pay dividends. Or maybe, oh, actually, since I'm on the stock one, I won't talk about the bond one because there are also bond income funds, but this is the stock section, so I won't talk about it. Um, this particular one is not a an income fund, so I just want to give you an example. And I don't want you to think it's an income fund because I'm putting it right by the income fund. But the Vanguard Total Stock Market Fund, and its ticker is VITSX. Let's take a look at it on Morningstar. Let's just, since I'm in the performance section, let's go ahead and look at its performance. So don't these numbers look a whole lot different from that prime money market fund? These numbers again, and I hope you can see it, it's the blue line that my cursor's on right now. These numbers represent the annual return the fund generated. So in 2005, it generated a return of 6.12%. 2006, 15, let's say about 16%. 2008, when the market crashed because of the financial crisis, this fund lost about 37% that year. But since then, it's done okay. It's done just fine. Although this year, which YTD is year to date, this year's not going great for it. But we still have a couple of months. Maybe the year will end up positive. Let's look at, oh, actually, let me go ahead and compare it to this. This line is the Standard & Poor's 500 return. So you can see the Vanguard Total Market Fund, Total Stock Market Fund, isn't doing that much differently from the S&P 500, but it's not moving exactly in tandem. I'm going to go ahead and go to the front page, the main summary page, just to look at the expenses. Look at how low the fees are for this particular fund. That's extremely low. I don't know that I've seen a fund that has a lower fee than that. They have a huge amount of money invested in them, almost $400 billion. I'll talk more about what the status means and the turnover. Now, this one is an institutional fund. It takes a minimum of $5 million to open an account, but they do have an equivalent investor fund. So I also want to look at the portfolio just to show you what is invested in it. This pie chart looks much different from that money market fund. It has very little money in cash, the bulk of it is in US stocks, a slight amount in foreign stocks. And here I can see the breakdown. It's got, gosh, over half of it is in giant and large cap companies. It has a small proportion of micro stocks and a small amount of small cap stocks. So if you were looking to invest in a small cap fund, this is not it. This one's diversified across all the different market caps, but it's not equally diversified across all different market caps. I wouldn't buy this fund as the only fund that I owned. A, because it doesn't have much in terms of foreign stocks. B, it doesn't have much in terms of small or micro. Let's check out the value versus blend. This particular matrix shows you, so this is deep value, high growth. This actually might show me a little better, but this does show me that the midpoint is essentially in the middle, so it's in the middle between value and growth, but it is focused, it's on larger companies. And I can see that here it's got about almost an equal percentage. This is the proportion of the portfolio invested in, let's say, large cap value stocks, 23%. Large cap growth stocks, 25%. If you sum all the values in this matrix, it should total approximately 100%. There might be some slight rounding errors though. So I can see this is nicely balanced between value and growth stocks. So if you wanted that balance, this would be a good fund for that. Again, it's lacking in terms of small caps and even mid caps. I can tell what sectors it's invested in down here. Sometimes they'll give me the totals for like the sectors. The 11 different sectors are broken down into cyclical, which means they have cycles, sensitive and defensive. Defensive kind of means they will move in the opposite direction of the market. Sensitive means they will move in the same direction as the market. And sometimes they'll break them down by like the total. See, since there are 4 sectors in the sensitive sector, sometimes I might see these sums tallied, but they don't tally them here. The utility sector has the smallest percentage. Only 3.01% of this fund's stocks are in the utility sector. Now you might think that's really low because compared to the technology sector with 17%, there's a big difference. However, I do want to point out that the utility sector is the smallest sector of the US stock market. The technology sector is the biggest sector. So if you wanted to be invested proportionally like and represent the overall US stock market, they're actually doing a pretty good job. When I compare them to the benchmark, which is basically the US stock market, I can see that their percentages are pretty much in line. Now, down here it looks at the geographical breakdown. I can see that the bulk of their stocks are in the Americas, mostly North America, and probably mostly US, not really Canada. And again, if I'm trying to be extremely well diversified, this isn't good enough. That doesn't mean you're actually not likely to find one single fund that is good enough, and I'll put that in quotes. But it might take 4 different funds to accomplish my objectives of being as well diversified as I'd like to be. Maybe to help combat the problems that this particular fund has in terms of not being good enough, I could find a small cap US fund that would help combat the problem of this fund being focused mostly on large cap stocks. I could find a total non-US stock fund that would combat the problem of this fund only having US stocks. So if I bought this fund and a small cap fund focused on the US and a total market fund focused on foreign companies, maybe that would be good enough when I combined all 3. But this one also focuses on developed markets and really has nothing in emerging markets. I want a little bit of emerging markets in my portfolio, so perhaps I could find an emerging market fund to balance out this as well. There are also bond mutual funds. These can be segregated by the issuer who issues bonds. So I could have a fund that only invests in government issued bonds like US Treasuries. I could have a fund that only invests in corporate issued securities. And actually there I'll say that later. Um, I could have a bond fund that only invests in foreign issued securities, so foreign companies or foreign governments. They could be segregated by the bond rating. So there might be a fund, there are funds I know that focus only on AAA corporate bonds, for example. Oh, actually, I'll go ahead and put this as well. Remember, the bond ratings have two tiers. There's investment grade, which are the higher quality ones, and then there's below investment grade, or sometimes they're called speculative bonds, sometimes they're called junk bonds. Some people are quite interested in investing in junk bonds. Um, I am not. I personally like my risk to come from the stock market. Junk bonds are really risky, and if I'm going to take risk, I'd rather it come from, like I said, the stock market. But not everybody has the same thought processes that I do. So they're wanting to take their risk in the form of junk bonds. So there are funds that specialize in junk bonds. There there are bond mutual funds that segregate based on the maturity of the bond investment. So that would be long term versus short term. So they might invest only in bonds that have 5 years or less until they mature, or they might invest in bonds that have only, a minimum of 10 years left until they mature. And then remember, bonds have coupon rates. We were talking about the Goldman Sachs bond that have 5% coupon rate. So they segregate coupons rates by low rates versus high rates. So you could have a fund that focuses only on low coupon bonds, or one that focuses only on high coupon bonds. As an example of a bond mutual fund, again, it's not the be all and end all, but Vanguard has the total bond market fund. Um, so I want to take a look at that. But actually, before I leave the total stock market fund, there was one thing I wanted to show you and I forgot. I'm under the portfolio tab and I've clicked through to holdings, because look at this. This one fund, if you were to buy shares in it, which you could do with only $3,000, this gives you a diversified stock portfolio that owns 3,805 stocks. Again, I don't think it's completely as diversified as I'd like for it to be, but still, just with this one fund, you've got indirect ownership in almost 4,000 different companies. So now let's go look at that bond fund. So it's the total bond market index fund for individual investors. Look at how many bonds you would have indirect ownership in. About 17,000. This is a fairly diversified bond portfolio. I'm going to go to the summary now, and we can see that the bulk of this fund's money is in bonds, 95%. Quality refers to the bond rating. Highest quality, medium quality, low quality would be junk bonds. This is the interest rate sensitivity. extreme, limited, or moderate is what that refers to. Basically, the longer term bonds with lower coupon rates are more sensitive to interest rate fluctuations than shorter term bonds with higher coupon rates. So this one falls in the middle. It's moderately sensitive to interest rate changes, and it only has, well, not only, but actually, yes, it does only have high quality bonds. And by high quality, remember the two main tiers of the bond rating are investment grade and speculative. This one doesn't have any that fall in the speculative category. 70% are the top highest rating. Uh, some of this stuff, I mean, duration is a measure of the sensitivity of the bond to interest rate changes, and I'm not really going to go into that, but you can look here, and the average maturity is approximately 8 years. So this isn't a short-term bond portfolio, it's longer term. This breaks it down by different sectors in terms of who issues the bonds that this fund holds. So the government, mostly the US government, issued about 46% of the bonds that this company holds, this fund. Corporate bonds make up about a quarter. Securitized are actually U.S. government agencies, so they have nearly a quarter of the money invested in agency securities. Municipalities, a very low proportion, and then again cash like certificates of deposit and things like that. The bulk of their bonds are in companies based out of the United States or governments, actually. So while this is diversified to some degree in terms of the United States, it's not diversified outside of the United States. So again, I wouldn't say this is the be all and end all of bond diversification. It's got some problems in the sense that it's not completely diversified, but it might be diversified enough for you. And then lastly, there are what they call hybrid funds. And I'm not going to go through any more examples, but a hybrid fund is going to be a mix of stocks and bonds. And actually, I will do one example. No, you know what? I'll save it for the next video.